Hello and welcome to another episode of Tell It Like It Is with your host, Manisha Kadagatur. I want to take a minute and thank all the listeners for the positive feedback that you've sent me. Do connect with me on LinkedIn and send me your feedback. And yes, do subscribe to the show on your platform of choice. Let's head on to the show now. My guest today is executive turned entrepreneur turned investor turned entrepreneurial investor, Jayanta Banerjee. He currently manages a mid-market private equity fund, ASK Pravi Capital Advisors, that he raised in partnership with the ASK Group. Born in Kolkata, Jayanta studied electrical engineering at Jadavpur University, worked as an engineer, and then went on to study management at IIM Bangalore. Jayanta was an investment banker before he turned an entrepreneur in the wake of the first dot-com boom. Thereafter, for almost 2 decades now, Jayanta has been in the private equity business. He's also worked with institutions like ICICI Venture and Lehman Brothers, and sits on the board of directors of multiple companies and is passionate about working with entrepreneurs and helping them in building lasting enterprises. And I know that Jayanta is also an amateur actor. On to the show. Hey Jayanta, pleasure to have you on the show, and hope you're safe and sheltering in place. So let's dive in, shall we? So Jayanta, first question to you, right off the bat, right? Why do you do what you do? That is back entrepreneurs.
That's a great question. Answer is at one level very simple and one level kind of complicated. Different people are built differently. Each one of us have our drivers. And what I have seen in my 3 decades plus of working, that these drivers also change over time. There was a time that all that I wanted to do is known to be a, quote unquote, high achieving employee, getting promotions, getting good bonuses and stuff like that. And as life went on, since I was an investment banker back then, I kept on meeting business owners. And I used to wonder that, what is it that gets them going? And I would imagine this was probably 98. I was meeting a very seasoned entrepreneur, I would say industrialist, that's the term we used then, even now perhaps. So he wanted to do something to do with this whole internet thing. He didn't have much of an idea. I went there with my boss, going to pitch some, fundraising ideas for his traditional business. But he was not interested in that. He said, see, all that stuff is fine. You're going to do some public issue, raise some debentures and stuff like that. Why don't we do something on the internet? And he had no idea what he wanted to do. We, on the other hand, were kind of brimming with various proposals, various entrepreneurs looking to do various kind of fundraisings. And then both of us, as we were going back to our offices, we were wondering that, we actually also had a lot of ideas. And why is it that we just raise funds for these entrepreneurs and then we keep on having our ideas and we don't do anything about it? And mind you, this was 98. I think it was early 99. The atmosphere was charged, the dot-com boom was happening. Certainly a lot of buzz in the US. The buzz of that was coming in India. I think the term Bangalore had already happened and stuff like that. So that was a time in this charged environment that I, along with a couple of other people, we decided to take the plunge. And hey, it took us probably just a day of pitching to one VC who agreed to back our, a closet business plan, if you will, and I became an entrepreneur.
Wow, one day?
Now, it actually happened. It was, I remember it, 40 minutes presentation. We hadn't prepared much because we thought we knew everything. Of course, being bankers ourselves, and all three of us were bankers, we'd had our PowerPoint presentation and Excel spreadsheets and stuff like that. But it took us 40 minutes, and we didn't know whether he bought it or didn't buy it. I remember that evening I was having dinner at one of my relatives' place. I was back in Calcutta then. And then, their office called probably, 8 in the evening. It's pretty late by Calcutta standards, and say, you know what, in the morning you guys came and we are on. I couldn't believe what I was hearing because, of course, I've raised money from others for others, but this was happening to us and it was happening like super quick. And then, I put in my papers next week itself and got going. And that's how my entrepreneurial journey started. Of course, it didn't really go very far because within a year or so, the dot-com bust had started taking place. By the time I was, I had my gardening and all of that stuff. I think it was early 2000. Then about within a few months, well, our internet plan was up and about to be launched, and that's the time we started hearing things crashing in the West. The boom was turning into a bust. All of that stuff was happening, and then slowly we realized we raised too little capital in the fear of diluting too much and stuff like that. And then within about a year or so, I think we realized the money that we raised was not large enough, so we moved on. One thing is there about this MBA training that we had is that we also know, I guess, when to cut losses. So I don't know whether the right thing to do or wrong thing at that point in time, but yes, we cut our losses, gave back whatever money we had access to our VCs, and became employees again. But then I guess life moves on. I got a chance to get into private equity, which was not being entrepreneur yourself, but backing entrepreneurs. And I just jumped at it because by this time, I think some kind of DNA change had happened. And, I always used to wonder, why did I give up? Was it the right thing to do, this cutting loss business and stuff like that? Anyways, things meandered. I got a chance to work with a very esteemed private equity firm of India, ICICI Venture. Joined there, got into investing business. And then again, I think after about almost a decade of working there, there was a time when we were wondering whether we should do things on our own instead of just being a part of an institution. And then along with two other, colleagues, started where I am right now, our current avatar, ASK Pravi, where we said that we are entrepreneurial managers ourselves, so we'll raise our own money and we will back entrepreneurs. So in some sense, that was a different part of the entrepreneurial journey, a journey which I'm enjoying a lot because there is an entrepreneurial element in the way we run the business ourselves. And of course, we are part of many entrepreneurial journeys every single day. So it's a different, world. But, something which I always think going back is that had we got some more guidance beyond just money from our VCs, I'm talking about, again, 20 years ago, 2000, maybe, we could have morphed a business plan a little. Maybe we could have pivoted out of that business to something else. But anyway, that's the story of 2 decades ago.
Wow, I'm still stuck with raising money in 40 minutes, man. I mean, that is stuff of legends. But yes, I think that's, and in one way, not many things have changed since then, right? Running out of capital, raise too little, and then the environment changing on you and stuff like that. So I think those things are still happening even today. Okay, so moving on. So how, now that you've set up an entrepreneurial investment shop for entrepreneurs, right? How do you spot a good idea or good talent?
See, there are 2 aspects of this. I think the first aspect is our investors always ask the same question. How do you spot good ideas? I think at one level, from a process perspective, it is very simple. You are out there, you are networked, ideas come to you, you go to ideas and stuff like that. But I think more important than just how do you get access to ideas, because that's the environment in which we are in, is also to decide what is a good idea, what is not a good idea. And after working for 30 years, I think it's actually a matter of bias. Some people's bias result in their being able to spot good ideas again and again and again, or good talents again and again and again. So there is, to my mind, there is nothing which is, fits in a particular format saying this is a good idea, because as you would have seen yourself in different walks of life, ideas which seem great, at a point in time don't seem to be, such great ideas later. So it all depends on the experience that one has, been through. It's really a manifestation of one's experience-based thought process. Also, we form hypotheses. All investors form hypotheses. What we think is, a good idea. Who do you think is the right talent to back? And I think that's what drives our decision making. Irrespective of all the Excel spreadsheets and modeling and, case 1, case 2, case 3s. But it's our bias finally decides what in our minds we think is a good idea or a great talent. But one thing I can tell you, Manisha, that experience says that whenever you think that you found a good idea, or you have spotted a great talent. Don't wait, act, because finally you might make a bad decision, but you would regret if you have not made that decision to know whether it was a good or a bad decision. So I think once you have decided, act. That is the mantra, if you will.
Wow. No, don't go so fast. No, you have to help me explain, to explain to me actually, this whole psychology of this private equity business. Because from the outside, it seems like, you're just wondering, how did they even back that, right? So how do you guys finally decide which businesses to invest in? I know you said you've got investment theses and blah, blah, blah. Please go ahead and demystify all of it.
That's what we do for a living, actually. The how do we make decisions, and many a times, like you said yourself just now, we also wonder that how did somebody else back, someone else? How did that business get funding? We looked at it, and we found it to be, not the greatest business and stuff like that. So I think the beauty of our business is also, like I told you, since things are not that obvious. I think for every business that gets funded by a investor, there are at least 3 times the number which sit down and wonder, why did this business get backed? And my short answer, and the short answer has a very long explanation, is that I think we start with a feel and then decide on our approach to the business. We do a lot of analysis, and then we finally end with a feel. As in, a final decision is also feel-based. Of course, that's not to say that we just sit down, raise money and feel twice and write checks. There is a lot of work that goes in. So, on a more structured note, there are really 3 broad areas that we analyze, and I don't think there is any rocket science in this. It is the industry, it is the performance of that particular business within the industry, and what in Indian parlance we call promoters, the entrepreneurs behind it. And the third one actually is probably the most important. Why probably? It is the most important thing. See, we invest in our fund into companies where these are not concepts only, in the sense that the concept has been put into practice by an entrepreneur, maybe with his or her own money, friends and family money. We're typically the first institution to come in. So there is one, of course, the industry to evaluate, which industry you're in, what is the dynamics of the industry at this point in time, what is the prognosis, and then how this business, assuming it's a 3-year, 4-year, 5-year-old business, how this business has performed. So we have a lot of, I would say, hard data to analyze. And the prognosis or the projection is based on, somewhat on the hard data and somewhat on, what we believe is a fair growth, projection, what could be the, new cost elements that can come in, what could be the market size like, what would be the competition like, and which are fairly, I would say, standard things. But I think the key thing which comes in and decides whether we made a good decision or a bad decision is whether we back the right entrepreneur. We were talking about talent. I think in this context, the talent and the promoter or the entrepreneur is the same thing. I'll give you an example, maybe, that may make it a little easier to understand how we go about this thing. See, this was, I think, 2014 or maybe second half of 2014. The retail industry was still booming in India. I think we actually came to know a brand which was doing extremely well. It's in the apparel segment. It was growing as if there is no tomorrow. It seems to have understood what its target customers wanted. It had got all the right kind of retail space across at least the major metros. If we put the numbers on paper, they were actually too good to be true, in the sense, not from whether they're cooked up numbers or not, but really, real numbers. But it looks like the business had everything going for it. And then, we all liked it. The first feel was very positive. And then we started engaging a lot with the promoters. And initially, it was all good. But as and when we went into deeper due diligence, we found that somewhere the promoter is not opening up, things which are not, these are not trade secrets we're asking for. You're more asking for business practices and, decision making, organization, all of that stuff. And more we dug, the cagier this person became. And somehow, we just didn't get comfortable. And we found that the promoter is probably trying to be too clever by half a thing. And finally, after a lot of deliberation, because it's not easy to let go of what's looking like a really good deal, right? So after a lot of internal thought process, etc., we said that, see, the two things look good. The industry has a positive outlook at that point in time. The performance was exceptional. It's just that we are probably not getting comfortable with the promoter. Is this a good idea, etc., etc. And I think on hindsight, we just again thank our stars that we took the call of letting the business go, because within, I think, 12 or 18 months of us deciding not to invest in the business, and this was not because of market reasons, but things started to unfold. The promoter actually was in the back. He was really focused on some other business. He really put all his energy attention there, and this business just withered. And actually, it's sad to say such a strong brand really wither away. And these kind of things, like I said, if I had to just do a financial analyst job, and the analysis was only based on what kind of numbers he had, what is the near term looking like, it was a go. But it was this discomfort with the promoters that made it into a no-go in the second feel stage. So my view, and at least in the Indian context, why Indian context? I guess globally, everybody would be of a similar view that finally it's the entrepreneur behind the business which makes the difference. And how do you choose who to back, who not to back? I guess that's what we are paid for at the end of the day by our investors, is the years that we put in, the bad decisions that we make, in sometimes even the good decisions also give you lessons. It's the judgment. So the judgment call as to whether it's the right entrepreneur to back is the key in our business. That's what I would say.
So this sounds more like what we do in hiring and selection. I mean, when we use different competency framework, we run a battery of tests, but eventually it boils down to judgment. So that's what you're saying as well. Okay, so good to know. Moving on. Now, when you started, you were one of the pioneers of building an ecosystem of operating partners to help portfolio companies succeed in India, right? But that model still has some challenges. What are those challenges? And how does an Indian entrepreneur behave differently from his Western or Asian counterparts?
I think that is the crux of private equity in India, because if you have followed this industry, I think the industry really became an industry of note sometime in, I would say, 2002, 3, 4. And that's the time when the main focus of the industry was basically to look at good businesses, put in some amount of growth capital, hope that it grows well, the entrepreneur uses the money judiciously, you take the company public, you make a lot of money. And then, as and when the industry matured, the recipients of capital matured, there was a time when there was a lot of hope, at least the Indian context, that it would become, it's not just the capital that we are bringing in, but also a lot of support. Now, unfortunately, I think my experience has shown is that, and I'm talking about only growth capital deals where you're doing minority investment and not majority investment, where that's your company, so to speak. But wherever you're doing minority investments, at least, and this is a disappointment for me at least, is the entrepreneurs, they can give a lot of lip service when you say that, we are bringing in capital, plus we have this team. For example, you might know that, we have a team of very senior, very experienced, what I would call functional specialists, people coming from marketing background, branding background, from manufacturing background. We have people who've kind of led companies, and they're available to our portfolio companies, and for free in that sense, because our whole idea is that these support, I would say, expertise that we bring to the table would have made a difference. But rarely, to be honest, I have found Indian entrepreneurs really trying to use this talent pool and get help. I think what I have seen, and I've heard differently as far as entrepreneurs elsewhere is concerned is that somehow Indian entrepreneurs are not really comfortable with folks they have not hired themselves. And that even goes on to consultants. Rarely, I wouldn't say always, but rarely have I found are entrepreneurs or entrepreneurs across where you have a minority shareholding really taking advantage of the functional support that an investor can bring in. And the other thing also, I think that somehow Indian entrepreneurs look at private equity investors more like clients who need to be managed, not like partners with whom you're aligned. I think that's where I thought by now, 2020, we would have a different story. But by and large, if you leave out the niceties that people talk about, if you get into it, wherever you are a minority shareholder, you're still by and large looked upon as a capital provider. And sometimes, of course, if you have superior knowledge of a specific technical area, like, for example, how to navigate IPOs, how to choose bankers, all of those things, they take your inputs. But as far as the core business is concerned, they still rely on folks they have hired, themselves. And well, I've heard things differently because I think this letting go of control is something which Indian entrepreneurs, by and large, are still to come to grips with. So, my two bits on this is that I think somehow in the ecosystem, entrepreneurs still look upon PE investors as just money bags, and they choose the guys who are going to give them the best valuations. But again and again, I tell people that don't look at investors only for valuation. Of course, I'm not saying you should sell yourself cheap, but within a band, don't look for just the money they bring to the table, or for that matter, even just the brand name. Look at how these investors have actually dealt with entrepreneurs in their in past situations. How have they partnered with them in the past? Go get feedback from entrepreneurs who have worked with these investors on their behavior, and that is the right investor to choose, and not just folks who bring you the highest amount of money or give you the highest amount of valuation.
It's interesting that you mention reluctance to accept feedback as well as handpicking people, because in some way, Janto, isn't that exactly what has ailed the functioning of boards in our country? Now, you sit on a number of boards as well, right? And that's some sort of impacted corporate governance, wouldn't you say?
Okay, corporate governance, depending on how you define corporate governance, I think as far as following the rules are concerned, yes. But even now, Manisha, I've been sitting on board for a long period of time, and small companies, mid-sized companies, some even large companies. I must say, without sugarcoating stuff, what the managing director or the promoter or the entrepreneur does in most of the cases is manage the board. Similar, like I told you about managing investors, they manage the board. Again, I don't think it means that they're doing something which is funny, but it's just that finally, context, there needs to be just one guy calling the shots. And while he hears the inputs, the attitude, the reaction is more of, okay, a good point and all of that stuff, but my situation is different. And in some sense, this, we are different, I'm different, this situation is different. It's something we have been, hearing all the time. So that's, that's a reality, right? Entrepreneurs finally trust only those folks that they have handpicked themselves, not people who are good to have.
Right. So, what advice would you give entrepreneurs in building good habits and breaking bad ones?
I think firstly, you have to understand your counterparty. Again, I'm talking from a PE investor standpoint. A PE investor is not an adversary. When a PE investor gives you money, it's not that it's lent money to you at any cost. It wants its money back with interest. It is a partner. So choose, like I think I'm repeating what I said, choose folks with whom you're comfortable working and interact with him like they are your partners. The other thing, I think I kind of would like to mention it is that the Indian context. I've seen this again many a times. Is this looking at businesses with a single metric? Some people just choose top line because he's heard or seen that valuation in this industry is only because of top line. Some people choose to go only for EBITDA, irrespective of where the balance sheet is. I think I think literacy is too harsh a word. I think people are financially literate, but this financial sensitivity of understanding that, whatever business you're building, unless of course you're at a stage where you're 20 years away from profitability and you're chasing a single metric, but by and large, regular businesses, the concept of return on investment, the concept of cash positive profits, and while we are talking about it, it brings me back to a session I had with Professor Ramcharan in 2000. It was quite some time back. I think it was 2008. Yeah, 2008. And there was this whole room full of entrepreneurs. It was a very nice hotel in Goa, and he was talking about cash positive profits. And folks like us, we were wondering, this is so 101. I mean, people understand that profits are not good enough without the balance sheet. EBITDA or PAT is not good enough. It all depends on how much investment goes behind. But Manisha, you'll be surprised. 2 years ago, I was having this conversation with one of my entrepreneurs who's an engineer, who's an MBA from a top business school, run his business, and he was arguing with me that we need to put in more investment in the business because we need to grow turnover, and profits will come. And this guy has run his business for 12, 13 years. So it's not a Uber in year 2 where you just look at a single metric. But yeah, I think I wouldn't call it a bad habit, but it's very, very important for entrepreneurs to understand the whole concept of a balance sheet. And somehow the finance function in most of the cases I've seen left separately as, it is the accounting function. But there is much more to
Correct.
finance than just the accounts. That's something. So in a nutshell, I think entrepreneurs need to understand the whole concept of financing a business, and they need to have trust beyond only those people they have handpicked themselves. They need to rely more on professionals, I would say.
So let's make this personal for you. What's in it for you?
You ask a very simple question to a private equity investor, and obviously, finally money goes in, money comes out, and if significantly a lot more money comes out, you make money. That is it. But yeah, that's obvious. It's like saying, why do you work? Everybody works. Rarely people will work without salaries. There's no reason for me to be in this business unless I hope to, make money. But in addition to that, I think 2-3 things, and they are not really cliches because I have worked for too many years to believe, at least make myself believe in those cliches. There's some facts. When you have invested in a company which was, just to give you an example, it was a 15 crore business, barely making any profits, and then 3 or 4 or 5 years down the road, it has not moved from 15 to say 1500 crores, but has moved from 15 to say 50 crores, and it is now making 40% EBITDA margin, is 20 crores. And then you backed a company where there were 100 employees. Now there are 500 employees. People who all employees in the company are really families. When you see you have been able to make the right choice of picking the right business, backing the right entrepreneur who has built a business which is in the process of becoming institutionalized, where he's actually been able to deliver not just to the shareholders, but also been able to deliver to his employees, where there are careers getting built, hopes and aspirations getting built depending on the success of this business. This sense of creation, that's, I think, a real substantial reward when you look back and see some of the successful companies we have invested in. When you've seen junior folks who've been hired into these companies bloom into becoming one level below CEO, some of them have moved on to become CEOs themselves. These are the things which actually gives you a lot more kick than if you had made a 5x or a 6x. Having said that, I'm not trying to say making money is not important. It is absolutely important, because unless you make money, all these things will not happen. But good chances that if you've made good money, the creation that you have you've left behind is blooming, that also will happen. So these are the things which which I would say are the rewards. There are different kinds of rewards as well when you have actually had companies which are on the verge of uh, getting into really difficult times. For example, there was a healthcare asset which we had invested in, and in our focus of trying to build a large asset, and we had leveraged a lot, and for some reason, for a period of about I would say about 18 months, the revenues were not commensurate. We were in a touch and go situation, then we were almost doing daily cash flow management and stuff like that because we didn't want to be a defaulting institution. So those are, very, very difficult situation. When you navigated out of the difficult situations, the experience that you have and the confidence that you have, having navigated successfully from a difficult situation, is also a reward, which you take home.
True. What about fears?
I'll tell you honestly, there's just one fear we have in this business, okay? Is that it's not so much about backing, say, a business which did not perform the way you have to, because that's part and parcel of the game. My fear is if I've made an error in judgment in backing an entrepreneur who may be very smart, but who's low on integrity. And unfortunately, I cannot say that I've never had this situation. I had this situation a couple of times. And that is my greatest fear, that to back somebody who's not dependable. It's not about having the capabilities. I think most people, by and large, whom you backed are smart people. But a couple of times I have this experience where we got taken in, and we have backed teams of individuals who have been low on integrity, and that's what terrifies me. And because I know that, and I've seen it with my own life, is that even if the person is very smart, most of the time, over a period of time, if you're low on integrity, irrespective of how smart you are, sooner or later, that lack of integrity will backfire on the business. And if you are an investor, that will backfire. So that's, I think, my biggest fear of backing, not an inefficient business, but I would say not an honest entrepreneur.
When you say integrity, this is not just financial integrity, but it's about keeping your word and your commitment and doing what you say you will do. That's what you mean,
Yeah, and
right?
by and large, it finally boils down to that, right? Why is a person, and these are all indications. Like, for example, if you have given your word to hire a person, and for some reason you decide to go back on your word, or you have treated your, I would say, suppliers badly from an integrity standpoint. It's not that you have tried to negotiate. Negotiating hard is different from treating badly. But all of these things, Manisha, finally, I'm telling you, it gets manifested in finally some kind of financial impropriety. That's what I've seen.
Right. All right. Time for predictions. What will hold for the next 18 months?
That is the easiest question you have, because I think you can ask this to anybody except for columnists. Everybody will say we have no idea. So we are entering completely uncharted waters. Completely uncharted waters. Nobody has seen this in their lifetime, and even in, I would say, recorded history. Because even if you take the 1918 example, there was no internet that time. There was not millions of people flying in and out. There was no China supplying the rest of the world. We had a world in which every area had their own catchment. Some amount of trade, etc., used to happen, but there's nothing compared to what it is now. The connectivities are tremendous. The implication of this on certain geographies, and let's talk about India, right? I mean, could anybody in here, whatever plannings they had done, whatever scenario of building they have done, they said, if I was an infrastructure company, I was a real estate company, to say 90% of my labor would have gone back, 1,000 kilometers away, and I don't know how to lure them back. I don't even know when my business will start again, right? There is going to be job loss. Job losses already started happening. There is going to be some businesses which can be permanently changed. Commercial real estate, we don't know what will happen. We have lots of companies where where we, in good scenarios, when we expand, we keep on taking commercial real estate. I was talking to one of my CEOs. Today is Thursday, last Wednesday, and we had doubled in terms of size and tripled in terms of our revenues. And we were discussing. He said, even if we double our revenues from here to 3 years from now, everything comes back. But we are definitely not going to take more space, because we are going to now make sure that some people are permanently working from home. Maybe they'll have hot desks and stuff like that. And this is a company where people used to come in every day, log in, go back, and stuff like that. So what's going to happen to commercial real estate? We don't know. The old lessons that we have learned from, say, the global financial crisis, the dot-com crisis, the oil crisis of the 70s, those lessons are not going to help. It is not about, I've been there, done it kind of a thing. It's happening, right? There's a shift in consumer behavior. For example, on the positive side, I mean, who could expect that school children, at least in urban middle class and above, are going to be doing their lessons on a regular basis in front of the laptop, right? What does it mean? It has implications on so many things, right? In consumer behavior, in financing behavior, right? The government has provided a lot of incentives to the banks to finance. Are the banks financing companies in trouble? No. Government's own behavior, one would expect, and I'm talking about India purely, one would expect normally that the government will push in a lot more cash into the system, where it the economy starts cranking again. On the other hand, of course, there is this whole question of where is our sovereign rating going to go if we have a huge fiscal deficit and stuff like that. So far, the government has behaved in a manner where we've tried to retain and not be fiscally profligate, and try to make a lot more enabling funding, as opposed to just pushing money into the system. Was that expected? Can anybody would have predicted that? Say, 2 months when the crisis had just started, most of the talk was the government is going to push in a lot of money. Look at the way society has, reacted to it. Again, different societies have reacted differently. I heard in China, for example, when the salons opened up in Wuhan, within a month, people have done 3, 4, 5 times the revenues of what they used to do, because all the pent-up demand came out. It's been about a week or so that in some of the Indian cities, salons have opened up. It's been good, but it's the capacity utilizations are about 50% what they used to be. We seem to be much more fearful as a society to re-engage. So how, what pace, when we are going to see, I would say, the economy become what it was, whether it will ever become what it was, whether society will ever become what it was. When I use the word ever, I mean, say, take a period of 18 months to 2 years or so. But that's a very long period of time when it's in the future. Uncertainty facing us. Many jobs will not come back at all. There are job losses. There will be some jobs which will happen again. But depending on how business gets delivered, many jobs may not come back at all. Remote working will become the norm. Remote learning will become the norm. So in this context, your question was about, I wouldn't talk about predictions for the next 18 months, but what would my input be to entrepreneurs for the next 18 months is, I would just say one thing. Whatever cash you have, use it very wisely. Now, and when I use the word wisely, Manisha, I don't necessarily mean use it miserly. To give you an example, that we have a services company in our business which does very well, sitting on a large pile of cash, makes money month